first, I think the market is a little ahead of itself there, and we actually see a possibility for a rate hike still later this year. And that, I mean, the Fed really pivoted since last year up until this year. They can pivot again. And if data stays strong and the U.S. consumer stays strong, we still see a chance for them to come back to the table. The implications to stocks if they cut later this year, I think if the market is not expecting that, they're going to think that the Fed knows something that we don't, and that's probably a negative sign.
So how does that mean your position relative to the market if you still think we could get a hike and people are moving the other direction?
Well, so if you look at it from a bond perspective, right now with yields as low as they are, we think the market may have gotten a little ahead of itself. So it's not necessarily a time to chase the curve. And what I mean by that is you don't really want to go out and take a ton more duration risk, which it sounds like is the consensus today. But in the stock side of it, not that you want to be overweight risk assets, but the fact that we think we still could see them come back to the table in this pause period, it's going to be supportive of risk assets, and it's okay to stay positioned on that side.
I mean, do you think that the Fed is going to continue to be a primary driver for risk sentiment and stocks for the rest of the year, as it has been in the beginning part of the year?
They have been a primary driver to positive risk sentiment in the beginning part of the year. The second quarter is going to be really tough for everybody. We're going to have earnings come in, and right now earnings are expected to be negative 3.6%, I think. We're going to have GDP growth that comes in probably a lot lower than it was in the fourth quarter. So I think the market is going to have to digest that, and I don't know that the Fed is going to be able to drive that much more positivity through Q2.